Seth, I ask just about every founder I interview, why or why not did they take venture capital? Why did they take venture capital versus bootstrapping? And you talked a little bit about that. Some shouldn't even be taking venture capital. When you're looking at a company, how do you look at it and think, yeah, this company should really take venture capital. This company should bootstrap or whatever.
Yeah, I mean, my going in assumption is that you shouldn't, right? So it's sort of like you got to not prove to me, but I think you should prove to yourself why you think you should take venture money because it's a bad deal, right? And for many people, right? I get preferred shares, which means I get my money back. Whatever I'm buying some percentage of your business. It doesn't matter. Uh, what percentage I end up buying, I mean, it matters from an economic perspective, but I still end up with all of these controls, whether I
Yep.
own 5% or 50% of your business. And so it's often not a great deal, right? You really need to be up for growing a business, growing it relatively quickly, and finding an exit, right? I mean, we're in the business of exiting companies at some
That's
point,
right.
right? Our funds have, I mean, no fund really is around for only 10 years, but in theory, 10-year
Mhm.
life plus 2 years extension at our option. So, the time is ticking, right? The clock is ticking when you take
Mhm.
money from VC. Now, that said, of course, many businesses either require that amount of capital, are
'Cause they
playing in
just can't,
markets
yeah,
that
they
are
can't do it.
that
Mhm.
large, are building technology where the tech stack needs to be built out very significantly before you can get to market. I mean,
Right.
there's all sorts of reasons why it makes sense to take money from a
Mhm.
VC, and then in that case, I suggest to founders that they're very careful about who they take money from. Right, the
Yes.
average time from investment to exit is 8 years. Right. That's actually
Yep.
longer, at least last time I checked the stat, that was longer than the average US marriage. Right. So just to give you a sense for the kind of, an analogy for the kind of
That's an
relationship you're
interesting
entering into.
statistic.
Yeah, right. And so, sobering thought on both ends. But why are marriages so short, and
Y y
why is
yeah,
the
right, right,
venture
right,
cycle so
right.
long? But in any event, like, you want to be careful about it and do your reverse due diligence and be really thoughtful. And certainly, I've seen companies decide to take money from someone that they've regretted, and in some
Yeah, well,
cases
I've
they
heard those stories
only.
100 times. Yeah.
Of course, I'm sure you right. Of course, you work on the people side of the business, so I'm sure
Yeah.
you hear this all the time.
Yeah.
Um, and I think that people should go into that
Mhm.
relationship with their eyes wide open. And I often will talk to founders very, very bluntly about here's here's how I like to work with companies, and I want to make sure you're good with that, because if you're
Mhm.
not, then we're not a good match, right?
That's
And
right.
every once in a while, you end up in a situation where there is that
Mhm.
sort of impedance, and so I mean,
Right.
one of the things that we've done a lot at Foundry that I'm really proud of is that we're not static in terms of who sees a business, who does the due diligence on the
Mhm.
business, and who takes the board seat, and then even who stays on the board. And so we're very fluid at each of those moments,
Mhm.
and I think that's served us well. We have lots of instances where someone saw it first, someone else did the majority of the due diligence, and a third person took the board seat. And in many cases, where a fourth person or one of the original two people took the board seat 2 years later, for whatever reason, right? We're
Mhm.
busy on our side, or the company's going through something, or in a couple cases, there have been some situations where we didn't feel like it was the right personality fit, and so we've
Mhm.
switched some things around. And I think that's really powerful. Unfortunately, the venture model tends to be more static than that. So,
Mhm.
and I think it's one of the things that I think could be improved about the venture model is that it's a bit stovepiped in terms of people feeling like they need to, own and control the best businesses. And I think some of that
Mhm.
also or stems from people getting credit, or maybe how some venture firms allocate carry based on whose deal is whose. So they want to hold on to the things that are working. And
Right.
fortunately, we don't have that partnership at Foundry, and I'm incredibly grateful for my partners for being open to that, and feeling like, look, every deal is a firm deal. We make our
Mhm.
decisions together, and if it doesn't work, that was our fault, and if it does
Right.
work, then we were successful.
Right. So when you are, there's a sort of common saying that, only 1 out of 10 investments pay back a massive return. And then, there's X number that, you'll break even on, and then there's the losers, right? Would you agree with that percentage, or have you been able to improve upon that? And if so, how?
It's more skewed than you think. 66.1% of venture investments, so that each round, fail to return capital. And
66,
something
yeah.
like 0.1% are greater than 100x. And so it's even more
Mm.
skewed
Yeah,
than
than that, right.
than the sort of conventional wisdom.
Mhm.
And Now that can still work really well, right? And we
Mhm.
actually almost followed that exactly in our very first fund. We blew up, roughly 2/3 of the capital, and it still was a 5x plus fund,
Mhm.
because we had some really, really big winners in there. And it's been interesting to watch. Our second fund was a little bit different. We were much more consistent. Um, for whatever reason, that might have been the style of investing or the
Mhm.
types of businesses that were being formed. The first one was 2007, the second one was 2010. Little still early to figure out from the other funds, but there's no doubt that there's a significant power curve in venture. And by the way, I think people have kind of forgotten that, right? I mean, if you look across the industry, there were so many write ups in 2020, 21 in particular, uh,
Mhm.
that I think people deluded themselves into thinking like, no, 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 my batting average is going to be a lot higher. I mean, you just look
Yeah.
at TPI across the industry. I think it peaked at like just over 7x. But the
Right.
industry average return is less than 2x. So we know from history that TVPI tends
Mhm.
to fall, right? So things get marked up. Not all of those things that get marked up will be successful. But we've just gone through this like crazy markup period, and we're only just starting to see that kind of come back to reality. Now, maybe it's an
Mhm.
incredible vintage and it does, I don't know, 3x, right? Which would be a huge improvement over the kind of
Mhm.
historic average. Um,
Mhm.
Again, I'm talking industry wide, right? Of course, there will be
Mhm.
individual funds that do that on a regular basis. Um, but that means there's still more than 50%, right? The market's still going to fall more than 50% from where it's marked today to where it
Right.
eventually ends up. And then if it falls back to more historical norms, and there's no particular reason to believe that it won't be at least somewhere in that range, right? I mean, there's always vintages that are better than others. And so, there may be some specific years in there that are a bit better. But
Mhm.
there's a bit of a reality check that's yet to come. And I
Mhm.
think that that'll be challenging, right? I mean, the truth is we haven't really had a pullback since 2008, 9,
Right.
right? And most people in venture today weren't in business, and if they were, they
Right.
certainly weren't in venture
Yeah.
in that time period. By the way, let
Yeah.
alone people that were in venture in 2000 and 2001, right? I'm dating myself because I'm old
Well,
now,
yeah, yeah.
BC, but
No, 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 none
this
of
was
us
the
getting
third
any
cycle.
younger.
Yeah, unfortunately, we don't, right?
Yeah, right. So if you look, if you could point to, so somebody sends you their pitch deck and, their spiel, here's what we're up to. At a high level, I know it's just far more complicated. At a high level, what are like the top 3 or 4 things that you are looking for in a company, a product, whatever that might be, for you to
Yeah.
say, "Okay, let's dig into this deeper."
I'm looking for a founder that is passionate about the product that they're selling and and specifically the problem that they're solving, right? So I start
Mhm,
with
good,
that.
right. That's what I always say.
Um,
It's the number one thing. They gotta have a problem that you need to solve.
a problem inside, and a problem that they care deeply about, right? I mean, I
Mhm,
think that there are plenty of examples of MBA students sitting around in a conference room doing a
mhm,
whiteboard and coming up with a good company, but the founders that we tend to gravitate for are people that sort of have a lived experience around something,
yep,
and they really
yep,
passionately want to see something changed.
yep,
Um, and so that's the thing we look for first. And then
yep,
obviously from there, do we think it's an interesting market that's going in an interesting direction? Do we think it's a big market, right? Or has the potential to be a big market? Doesn't have to be today, but it could be at some point in the
mhm,
future. Do we believe that they're playing into a trend that's a positive trend? Do we
m'kay,
think that there are a lot of customers that they can access at a reasonable acquisition cost in this
mhm,
market?
mhm,
Um, and then finally, what do we need to believe in order for this to be a big outcome, right? We've got big funds. Now we've combined our funds together. So the fund of funds
mhm,
is part of the direct investment fund. So,
mhm,
our latest fund was a $500 million. We
right,
need companies that can be pretty big in order to move the needle on that. And so we always ask ourselves, well, what do we need to believe in order for this to be a big outcome? And by the way,
mhm,
we don't just ask ourselves that in the first round. We have to ask ourselves that every time we put capital into a business at some valuation. What do we need to believe in order for this to be a big outcome?
right,
And that's an explicit conversation that we have as a partnership that I would certainly encourage VCs that are listening. That I think that's a really important question to be able to answer, and entrepreneurs for that matter, right?
yep,
In some respects, they've got the harder bargain because they're not just putting in sort of their own capital, either directly or in the form of opportunity cost. doing something else, but they're also putting
Mhm.
in, this immense amount of time and effort, and believing that it's gonna be an outcome. Well, what do you need to believe in order for it to be a really, really big outcome?
Carol Schultz here. Thanks for watching this excerpt from Authentically Successful. The conversation doesn't end there. So if you want to hear this episode in full and all my conversations with many other successful founders and CEOs, please visit verticalelevation.com/podcast.